I'm Nehal Joshipura, Assistant Professor Finance from Durga Devi Saraf Institute of Management Studies, and I'll take you through the decision of asset allocation. And the very first step in the process of portfolio management or the investment process is asset allocation. Now, this asset allocation can be at two levels. The first level is when you make the asset allocation choice, you divide your money or your capital between risky and risk-free assets. The second step would be within these risky assets, within the portfolio of risky assets, you may decide whether how much to invest into stocks, how much to invest into bonds and the other alternative assets. So, this is the two-step process of asset allocation. Now, I'll take you today through the first step of it, that is capital allocation between risky and risk-free portfolios. Simplified version is I decide how much of my money should be put into risk-free assets, that is maybe government securities, and how much of my money should be put into the risky assets yielding higher return, but yes, they are risky. There is some risk of default in that. So, depending on my risk averseness or my risk tolerance, I would divide the money between the two parts. So, let's take an example. In fact, let's assume that the proportion of money, the proportion of total capital or the funds invested into risk-free assets is risk-free assets plus risky assets has to be 100%, or when I measure in decimals it should be 1. Now, out of which I presume that let's assume that risky portfolio is having Y proportion. So, the remaining part will be invested or into risk-free assets, and that will be 1 minus Y. So, for example, if Y is 0.1, 1 minus Y would be 0.9, right, 10% and 90% like that. So, similarly, so on and so forth. Now, let's take forward this example with two hypothetical portfolios, one of risk-free assets. Now, here in case of risk-free assets, we can take example of maybe T-bills, treasury bills of government or government securities or something of that sort. Would provide us an option where it's virtually there is very less or minimal risk of default. So, we consider this kind of assets as risk-free assets. So, there is one risk-free asset, the other could be entire gamut of risky portfolios wherein you can include stocks, bonds, alternative assets, maybe real estate and all other things like that. So, I have here taken two hypothetical portfolios, where in the first portfolio, as you can see in this screen, risk-free portfolio is having a return of 8% and being risk-free, its risk is 0%. By the way, we are measuring this risk by using standard deviation of returns. Return is what you get over some holding period. When I hold a particular portfolio for a period, after this holding period, I am getting some R percentage of return. So, that is return, and when I measure the deviations in this return using standard deviation, I would call it a measurement of total risk in my portfolio. So, risk here for the risk-free portfolio is 0, return is 8%, and for the risky portfolio, we are presuming it's giving you a return of 18% with the risk of 15%. Okay. Now, with these two hypothetical portfolio and assuming that we are investing Y a proportion of the total funds into risky portfolio and remaining 1 minus Y would be automatically invested into risk-free portfolio. So, with this example, let's go forward. Now, suppose if I want to calculate the return and risk for this mixture, that is my entire portfolio. I would call it a complete portfolio. In fact, a complete portfolio is a mixture of risky and risk-free both. So this is a complete portfolio of a client or of a person. Then for this complete portfolio, I would be interested what would be the risk and return of this complete portfolio. That will tell me what is the effect of the mixture, how should I mix them up. So this can be measured, as you can see in the screen. It can be measured, the formula is given, it's simple weighted average, remember, nothing more. It's simple weighted average. The return is the weighted average of RP. RP is risky portfolios return, and Y here is the proportion we are investing into it. So Y multiplied by RP is the return generated from risky portfolio, and 1 minus Y multiplied by RF. RF is a return of risk free portfolio. So risk multiplied by 1 minus Y will be the return from risk free portfolio. So adding up both, we get total complete portfolios return RC. So we have the formula for RC, and when we measure risk, standard deviation sigma C is equal to simply Y multiplied by sigma P, because risk free doesn't have any risk. So we are not taking it into account, and the risky portfolios risk multiplied by its proportion, so that much risk. And as you can see here, when Y is into decimals, so we are reducing risk by creating a complete portfolio. Now let me take you forward to the practical implications of this formula. See, there are three ways. People think different ways. People decide about their portfolio in different ways. What they do is, sometimes they decide, okay, I want to invest by some thumb rule, or maybe by gut feeling, or somehow they decide, okay, I want to invest 0.4, that is 40% of my portfolio into risky assets. That's it. I'm determined about that. I have decided I'll invest 0.4 proportion of my portfolio into risky assets and remaining 0.6 into risk free assets. So that's how I have decided. Now the only what remains is, now I need to calculate return and risk for the portfolio I decided. So this is how I make the choice. One more way of making the same choice could be, I might be targeting some sort of risk. That is, I will say my risk tolerance is, see, risky portfolios risk is 15%, return is 18%, but risk is 15%. I would say no, I am risk averse. I cannot tolerate this much of risk. I cannot tolerate 15%. I can tolerate only half of it. I can tolerate 7.5% risk only. Now in such case, as you can see in the third row of the table, here you are determined, you have fixed up the risk target, risk tolerance level, and depending on that, now you will calculate what should be the proportion that I would invest into risky assets so that I get this 7.5% of risk. So you ask yourself, and that's how the decision is made. The third way could be, I might be targeting a particular level of return. See, I want, the market is giving, or the risky portfolio is giving 18% return, the risk free portfolio is giving 8% return, 8% is too low for me. 18% is high enough, but then it comes with the risk, so I don't want that much of risk, so I am okay with 14%. If you give me 14% return, I'm okay with it. So now, as a client, maybe I would ask my planner that, I would ask my financial planner that you prepare a mixture for me, you give me the proportion Y in such a way that I end up with 14% return, whatever be the risk. I know the risk will reduce, so I am okay with 14%. Okay, so these are the ways people think about their capital allocation between risky and risk free portfolios. So I have shown all these three examples in your second, third, and fourth row of the table. Now we'll calculate each case separately by using the formulas given earlier. The formulas which are there on the screen, we'll be using them to calculate the risk and return in all these three cases. First of all, I'll take the first case wherein our proportion is fixed at Y is equal to 0.4, and we want to find out if the portfolio, if there is a complete portfolio with 0.4 proportion of funds, allocated to risky assets and 0.6 proportion of the funds allocated to risk free assets, then what would be the ending complete portfolio's risk and return? Okay. Now here you can see the calculation for return. It will be weighted average of both 18 and 8, multiplying them by their weights, their proportions, that is 0.4 and 0.6, and then we end up at 12% average, which is between 18 and 8, and we get this 12% as a return for such a combination which is having 0.4 proportion Y. Okay. Now standard deviation or risk, complete portfolio standard deviation sigma C will be, C stands for complete portfolio here, sigma C will be 0.4, that is the proportion of risky portfolio multiplied by its risk. So 15%. The multiplication gives us 6%. So 6% is the risk. We end up, you can see there is a huge decrease of risk. 15, from 15 we are ending up with 6 only, because we are investing less than half of the portfolio funds into risky portfolio. So we are getting the answer for the first second row, that is the first choice. Now second choice is, here I have risk tolerance which is fixed up. My risk tolerance is 7.5%. I don't want to, I cannot tolerate any further. I cannot tolerate more than that. Now my question is, as an investor, I can tolerate 7.5%. I cannot tolerate 15% of market risk. Now as an investor, you would ask yourself a question, how much do I then invest into risky portfolio, so that I end up with a risk which is equal to 7.5%. Okay, let's calculate. Same ways, if I put into the risk formula, sigma C, that is 7.5%, is equal to Y proportion, we don't know Y here, multiply by 15, which is the risky portfolio's risk. So if I plug these numbers into the formula, I get Y is equal to 0.5, and using this Y 0.5 I can calculate RC also, because now I have all the numbers which are required. So 18 and 8 I get exact average, which is, because it's 0.5. So I get the exact average 13%. Now the third choice, so we are now ready with the answer to the second choice. So second level of decision making, and the third category of people would think, okay, I want to target my return. If I am investing, obviously the maximum temptation emerges from the return which I get. So I am targeting a particular level of return. I say market is giving 18% with a higher risk. No, I am not ready for that. I am okay with 14% with lesser risk, but not as less as risk free. So yes, I want 14%. That's what I am planning to have, and that will satisfy me as an investor. Now my question here is, what should be the proportion I invest into risky portfolio, that is Y. I want to find out Y over here, as well as risk. So here once again we plug in the numbers into RC formula, because we know the return. So we, in the written formula, we are putting in the putting the numbers, and when we solve this equation we get Y is equal to 0.6. So the answer is, if I invest 60% of my funds into risky portfolio having 18% return and 15% risk, as well as rest of the money, that is 40% of the funds into risk free portfolio, the combination, this particular combination will yield me 14% return. So similarly you can calculate sigma C, as you can see in the screen, it's 9%. So now we are ready with this different choices. Now this table shows you a particular options. It shows you various options between the two extremes. This one extreme which is risk free, less return, no risk. The other extreme is market return, and risk, which is again risk pertaining to the risky portfolio. Now this depends on your risky portfolio, the combination which you have made into risky portfolio. So your risk and return will be commensurate with that. So I have chosen one risky portfolio, or one risk free portfolio, between these two extremes, the way I mix them up, the way I decide my Y, my allocation, funds allocation, I'll be somewhere in between. As you can see in this table, the return and risk are in between. So I'll be moving on this line. Yes, these points are linear points, and if I draw the graph of it, that graph will be called capital allocation line, because these points are showing me various ways in which I can allocate my capital between risky and risk-free portfolios. So let's see the diagram. Let's see that line. Now this slide shows you the capital allocation line using the risk-free portfolio with our example, and risky portfolio which we have taken an example of 18 and 15%. So between these points, these three choices, 0.4, 0.5, 0.6, y is equal to 0.4, 0.5 and 0.6. These 3 points are lying on this line. Now as you can see here, this is a straight line, and that's the reason, obviously, like any straight line, here the slope has to be constant. The slope has to be constant. If I calculate the slope of this line, it has to be a constant across all the points of the line, and all these points on the line are representative of various choices or various combinations of this particular risk-free and risky portfolios. Okay. Now with this, let's now move on to the slope, calculation of this slope of this line. Now how do we calculate the slope of the line? We calculate the difference in y divided by difference in x, and that's how we come across the slope. Now here there are 2 points, risk-free portfolio, risky portfolio. We have x and y for both. As you can see in the line chart, we have on x-axis we have risk, and on y-axis we have return. So difference of return divided by difference of risk should give me the slope. So this slope is in fact known as Sharpe ratio. Sharpe ratio, known after William Sharpe. Sharpe ratio is basically the difference of return divided by risk. So the formula for Sharpe ratio is RP minus RF, that is risky portfolios return minus risk-free portfolios return divided by risky portfolios standard deviation. Risk-free doesn't have has 0 standard deviation, 0 risk theoretically, so minus 0 doesn't make difference. So that's how we have this formula for Sharpe ratio, that is RP minus RF divided by sigma P. As you can see in the on the slide, we have calculated that 18 minus 8 divided by 15 from this table, and we come at 0.667 rounded to 3 decimals. So this is the Sharpe ratio for this particular capital allocation line. Now depending on your risk tolerance or averseness, you can move on anywhere on these lines, you can move. Now what if I'm greedy enough to ask for more than 18% using the same risky portfolio? I agree with the investment philosophy of this particular risky portfolio. I agree that yes, the stocks are good, these bonds are good, these other assets are good in my portfolio, but with this risky portfolio, using the same risky portfolio, I aspire to get more than 18%. Can I get it? Probably no, if I don't borrow my money. If I invest 100, because with this combination, if I invest 0% in risk-free assets, if I invest 100% in risky asset, then maximum I can yield in, as you can see in this line, the line stops at 18 and 15% combination, that is the RP and sigma P. So maximum I can yield is RP and sigma P using this particular combinations, right? Now what if I borrow the money? I have 100%, if I invest all 100% into the risky portfolio, maximum I can earn is 18%. But what if I borrow 20% and then I'll borrow certainly at some lesser rate, some rate which is lesser than 18%, I'll borrow the money, I'll earn on this borrowed money whatever percentage I borrow, maybe 20%, maybe 30%, maybe 50%, whatever money I borrow, using this borrowed capital, see, I'll be earning 18%, I'll be paying some less return, maybe 10%. So this difference gets me some benefit. It can increase my average return on the entire portfolio. So let's check out this possibility also. The first three lines are showing you the possibilities between 0 and 1. The fourth row, as you can see here, is showing you the combination of 1.2. Y is equal to 1.2 means 20% of my capital I am borrowing at some rate. I am borrowing at some rate which is lesser than 18%. And I have to pay back, of course, on this 20% I have to pay back the interest rate. I have assumed here 10% to be the interest rate. So 10% I will be paying, but I will be earning 18%. So I will invest entire 1.2, that is 120% of my portfolio, my capital into risky asset. And the last row shows you the combination for 1.5, that is 50% of your capital being borrowed. Okay, now let me pause over here and explain you what is happening exactly over here. See, the idea is if I can borrow at the same risk-free rate, then the line which you can see on the slide could be continued. If I could borrow on at 8%, and then if I can invest 120% of my money into risky portfolio, then on the same line I would have continued my journey, along the same line I would have continued my journey, and I would have yielded my return. But what practically happens is, can you borrow at the same rate at which government is borrowing? What is your risk-free rate? Your risk-free rate is treasury bill rate. Treasury bill is an instrument for the government to borrow money from public. So can I borrow, do I have the same credibility which government is enjoying? Of course no. So I cannot borrow at the rate which is RF, because being an individual, of course I have some credit risk. I have some risk of, I carry a risk of defaulting. So I will be borrowing naturally at some rate which is higher than RF. Of course I'll see to it that I borrow at a rate way lesser than 18%. So let me presume I am borrowing some money at 10% of the rate. So if I am borrowing at 10% and then if I create a graph, see, when you borrow at 8%, your line continues like this. When you borrow at 10%, your line will be slant. Its slope will reduce. So here we see a kinked graph. There is a kink in between. The graph has a kink in between. The graph doesn't continue continuously because it has to change its path. So the blue line which you can see over here is showing you the line bit for y less than 1 when you have not borrowed. But the red line is the area where you are borrowing. It can be continued further. So where you borrow the money, where you borrow some part of your capital and you invest the entire capital along with the borrowed money into risky portfolio, and then you pay back at the rate you have borrowed. So here borrowing rate is 10%, which is presumed. So from 10%, if you say imaginary line, that will continue like this. So here we see the kink over here. So this is called kinked capital allocation line. So the two main concepts we have done is capital allocation line without borrowing and capital allocation line with borrowing. So with borrowing, yes, you can increase your return. Oh, that raises a question in my mind. Then shouldn't everyone borrow? Because it is 18%, 15% portfolio is anyways available. If I borrow, I can increase, I can earn more than 18%, as you can see in the table. Here, the person borrowing 20% of money is getting 19.6% using the same portfolio. Person borrowing 50% of money is getting 22%. Oh wow, getting the same portfolio, 18, 15. Then, am I not tempted to borrow? Should I not conclude that I should borrow? I must borrow rather. Oh, Let's check the Sharpe ratio in this case. When we calculate the Sharpe ratio for these two combinations, because these two combinations also 1.2 and they fall on this red line. So naturally they both have the same, all such combinations fall on the red line which are borrowing. So they must have the same slope. So their slope or Sharpe ratio comes to 0.533. So Sharpe ratio is decreasing. Now what does that signal to me? Let me check the Sharpe ratio formula. Sharpe ratio formula is excess return as we call it actually, technically, RP minus RF, that is beyond risk-free return, beyond what is given to any Tom, Dick and Harry without assuming any risk, that is RP. Minus RF is excess return. So excess return, the return which is given for risk, divide by risk. So per unit of risk, how much return can I get? It's something like, I bear the brunt of risk. So what am I getting? I am getting RP minus RF by bearing this additional risk which is not there in RF, risk-free portfolio. So this is called, the Sharpe ratio or the slope of this line is also called risk adjusted return, or in other words it's reward to risk ratio. So this reward to risk ratio shows me the performance of the portfolio. It shows me, given this level of risk, how much excess return I am generating. So you can actually compare any two portfolios using the Sharpe ratio. That performance can be compared using Sharpe ratio. So here we are compromising, as you can see here. Yes, you can, with borrowing you can earn higher, but this higher earning comes at a cost. At a cost in terms of reduction in Sharpe ratio, reduction in the performance of the portfolio. So this higher borrowing, obviously borrowing is while you are borrowing, you have to return this money, and in this process your risk is increasing. As you can see here in this on the slide, 18 and 15%, risky portfolio had 15% standard deviation, but the borrowed portfolios are having 18 and 22.5%. Risk is increasing, and that's the reason Sharpe ratio is decreasing. So yes, if you are ready for a particular decrease in Sharpe ratio, yes, you can borrow and you can have your investment on this red portion of the line of the Kinked capital allocation line. So this is the realistic way in which people allocate their capital. People have different choices across this line, this Kinked capital allocation line. People have their different choices. And now let me move on to the next concept after completing this capital allocation line, Kinked capital allocation line. Now the next level of decision making. See, I said risky portfolio, we are presuming this risky portfolio. Yes, we are presuming this is the risky portfolio. Maybe my PMS, somebody has prescribed as a part of PMS, or somebody has assisted me, or I myself have decided, okay, this is the risky portfolio. Now this is the concept of market portfolio. Market portfolio meaning a portfolio which is representative of the entire market. Now here practically what we take is, suppose if I want to choose a popular one, I would choose Nifty. Nifty is representative of the market, of all the stocks on NSE, listed on NSE. So if I want to choose popular index, maybe I'll take Nifty 50 having 50 stocks. And if I want a more representation, maybe I'll take CNX 500, once again an index on NSE, representative, more representative or better representative of NSE stocks, because it has 500 stocks instead of 15 Nifty. So here now these are the examples of market portfolio practically. So if I compare these things, this scenario with the market portfolios cal. See, every risky portfolio, risk-free portfolio is what everyone knows. Like in India, we have T-bill return which is around 7.6%. So Risk-free portfolio everyone knows, risky portfolio everybody has his own, depending on your choice and various things. So, similarly, so every risky portfolio will have its own capital allocation line. Similarly, market portfolio also is a kind of risky portfolio which is representative of almost all stocks listed in the market. So, if I create a capital allocation line with the market portfolio, what will happen? I'll again go for the same sort of calculations we have done, or we have already learned how to create a portfolio with this risky 18%, 15% portfolio. So instead of 18 and 15, if I use this 20% and 15% for the market portfolio or some index portfolio, then the lines would be, if I plot that graph, I'll be getting this sort of graph. Now this line, capital allocation line between risk-free portfolio and market portfolio as a risky portfolio, will be called capital market line. And as you can see in the graph, the capital market line generally supersedes, it is superior to any other capital allocation line as per some theories. So capital market line normally yields better returns, has lesser risk, so it is superior to capital allocation line as shown in the graph. So the idea is that is why there are many funds which are launched, they are passive portfolios or passive investing, they are following passive investing strategy, wherein they invest, they say it's wise to invest if I don't want to analyze the market, if I don't have time to all the time look at the screens and tickers and all, if I don't understand the financials of company, or maybe I don't have time to track them all. In such case, instead of actively investing, I can passively invest into a market portfolio, some index portfolio which is representative of market portfolio, and yes, I'll be having a superior capital allocation line called capital market line. So with this we have covered three major concepts to summarize with: capital allocation line, kinked capital allocation line with borrowing permitted, and the third concept is capital market line. Thank you.